and a warm welcome to Talking Stocks. I'm Gugulethu Cele. In studio with me, I'm joined by Ashton and Hechter, both from Anchor Capital. Now today we're talking about South African banks, especially at this point in time in the South African market where the macroeconomic conditions clearly do play an impact on these institutions. Gentlemen, thank you so much for joining us as always. Talking about the big four banks, I do know that our colors are often blue, turquoise, red and a bit of green, but I know that Capitec and Investec have been excluded out of tonight's conversation. Let's perhaps begin there by clarifying why.
Sure, I think so. If you look at a company like Capitec, it's a much smaller operator. It is naturally exposed to the South African banking industry, but part of this review is as much a review of the overall landscape within which South African banks are operating. And the big four banks don't have enormous ability to gain huge shares from each other. Capitec clearly does, and we've said that in the past, so we've excluded it on that basis. And Investec is a bit of a different animal in the sense that they have a significant chunk of their business unrelated to the business of banking, and it's also very much an offshore operator, roughly half their business outside of South Africa. So when we're talking about reviewing the banking industry, we're talking about the big four, and it's an assessment of the environment in which they're operating in the South African economy, as well as the businesses themselves.
Mm-hmm. One would think that with the regulatory controls that we have in place, though, these companies must be well capitalized to weather the storm. Is this the case, Liam?
Yes, I think our banks, if you look at banks globally, they would stack up quite well. I think they're very well managed, they're well capitalized, and over the years they've been run in a very conservative manner. So if you look at how the SA banks performed through the global financial crisis when the global banking sector, if you look at that sort of around the world, those banks were on their knees, and South African banks fared very well in those conditions because of top quality management teams and lots of capital. And there's no different at the moment. They're still well capitalized and well ahead of their sort of Basel III targets.
Mm-hmm. I mean, many would bring forward the concerns regarding our sluggish economic environment in South Africa, rising interest rate cycle, and even the reprieve that we receive from the ratings agencies. Are these things that we believe that our banks have buffers against in the short term?
Absolutely. So I think that banks have seen a lot of this coming for quite some time. When you talk to the management teams, I don't think there's any of them saying that a downgrade risk isn't a real possibility for South Africa. So I think that they've been very cautious in the manner in which they've been extending debt to consumers. Nedbank is one in particular that sticks out in my head as being a business which has not been very aggressive with loan expansion to the South African consumers, and their books are probably a bit cleaner than they've been for some time. So yes, I think the industry as a whole is quite well provided for I'd say a once-off shock. I think the greater risk, which Liam will flesh out, is an extended, protracted economic winter for South Africa. So in the event that final demand remains very weak for some time, you have a credit downgrade which results in tightening of credit extension to the business and consumer sector in South Africa. So if we go into an extended time period of subpar economic growth, well below kind of 1.5%,
sure.
That would be very difficult for the banks to stomach. So I think that they can cope with a once-off shock, but what you don't want to see is a long period of time of very low growth. That would result in an uptick in credit impairments of historically very low levels, I would say. And that clearly is going to be a headwind for these businesses. Mm-hmm. Also, historically the banks have had the ability to put through quite chunky fee increases. I think in this environment, particularly where you've got a new competitor in the form of Capitec, they're not really new, they've been around for a while, but they're increasingly gaining the attention of consumers out there, and they've become quite a big force in the local market with a very low fee model for their transactional account. It's going to be quite hard for the likes of Barclays, Nedbank, even FirstRand to put through very aggressive fee increases to their consumers. That's a new dynamic that's emerged in recent years. So using fees as a lever to drive growth is going to be quite tricky.
Mm-hmm. Let's touch on some of the technicalities now, and I understand the banking index certainly seen a significant re-rating since mid-2015. Walk us through the numbers here.
I guess if you looked at those banks in an EMEA context, so in the context of sort of the emerging markets globally, our banks probably stacked up as some of the more expensive banks. And at the time, I don't think a lot of the risks to the South African economy had been priced in. So I think if you look back at our positioning, we were very cautious at that stage, thinking to ourselves, why would we be paying up so much for these businesses? If you looked at a global map and you looked at the South African economy, you wouldn't really be pointing at that place going, structurally that's a good economy, or those conditions are conducive for growth in the banking industry. So I think what you've seen is that the risks have now largely been priced in, the market takes a bit of time to price those risks in, and at the moment you probably seen most of them most of the banks' share prices reflecting a lot of the risks that Sean's already mentioned. So at the moment they've derated from, I think the sector as a whole peaked at about 1.8 times book value, and now they're at what you'd probably consider sort of cyclical lows in terms of valuations, but ultimately with headwinds in front of them.
Given this re-rating, though, I take it this is how we'll probably also get to separate the winners from the losers once we do see substance in the numbers and earnings really coming through to give us some kind of indication with regard to what return on equity, as to who the clear winners in the banking sector are.
And it's a tricky one now, because from a valuation point of view, you've got the sector trading at relatively low levels, kind of 4 to 8 times P multiples. In many cases between 5 and 7% dividend yield, 7% in the case of Barclays. And the way we're thinking about how to pick how to pick stocks within this environment is to say, we want to be protected by valuation first and foremost. So something like Barclays would stick out as looking relatively attractive on that basis. And B, we don't think top line growth and loan advanced growth in the kind of economic environment that we foresee in South Africa is going to be a huge lever of earnings growth. So we want to try and find the companies that have the best ability to manage their costs. And if you look at something like Barclays, I think their most recent reported numbers are something like 5% cost growth, the only bank in the sector delivering positive jaws in terms of the rate of turnover growth relative to cost growth. I think when you look across the sector, it's going to be quite tough for them for all of them to maintain positive jaws, which probably means a decline in return on equity profiles. In fact, I think Barclays is one of the few where we're not forecasting a reduction in the ROE over the next year or so. But as a general case, we want to have protection in the form of high dividend yields. And a cost lever to pull in what's quite a tough economic environment.
I mean, just to touch onto that. So, I mean, at Anchor, what we did was we created a bit of a framework to decide how we're going to pick the winners in the sector. And as Sean's alluded to, the fact that some of the banks have more flexibility in the expense base. So a company like FirstRand as well, while we are forecasting quite a sort of high expense growth, a lot of those expenses are variable in nature. So people's remuneration is linked to performance, and if the bank's performing well, that sort of pushes the expense base up, but at least they've got the ability to flex that. Then also, I think what Sean didn't mention that I will is the provisioning. So what we also look at is making sure these banks are well provided with overlay provisions ahead of what they're currently experiencing in terms of the non-performing loan portion. So over the years, some of the management teams have had the ability to tuck away provisions to ultimately weather what they would expect as a negative growth environment, leading to a tick up in bad debts, and then obviously protected by the valuation.
And that's where FirstRand looks best positioned. So it's not the cheapest bank. You're paying about a 410 PE for it. And quite a high price to book multiple by virtue of the fact that the return on equity is very high. But they've got far and away the highest portfolio provisions relative to performing loans of the big four. So that probably means that they can show, if they need to release provisions through the income statement, they can do so, and it means that they can show sustainably higher growth for a little bit longer than one might expect in a tough environment.
Well, let's find out from our experts now whether to buy, hold or sell South African banking stocks. So Liam, looking at the South African banking sector, is this one to buy, hold or sell?
At the moment, we are neutral on the sector. Within the sector, we believe that Barclays and FirstRand stand out for us as the two that are going to outperform Nedbank and Standard Bank. Looking company specific, Barclays' ability to flex the sort of cost base, and also they've got a huge retail banking franchise which has fared more over time been more defensive in periods of tough growth. FirstRand, we believe the management team's the best in the sector, and we believe they've got levers to cross-sell into the existing client base that they've got in FNB. So those two banks for us stand out as buys versus the other two, which we're not as positive on.
Your thoughts, Sean?
I would largely echo that view. I think that there's optically they look very cheap, and many people might be inclined to be piling into these things. But ultimately, you've got to look at a 5 to 7% dividend yield in the context of an environment where we're forecasting mid-single-digit earnings growth to possibly up to 9% for some of the better ones. But I think there's downside risk to those numbers if we have an extended downturn in the economy here. So we're very cautious about the earnings growth outlook. We're playing it defensive in this sector. That's why we want to have a lot of our return in the form of dividends. We're not expecting big capital growth. I do think there's the potential to get double-digit returns, but it relies on kind of the earnings forecast that we've got coming through, which we wouldn't say that we have 100% conviction in. I think on the negative side, so what would we be shying away from right now? Liam would have mentioned Standard Bank, and really the thinking around that is to say a significant chunk of their value is in the form of their African assets, where we believe the implied cost of equity being placed in those assets is too low relative to the risk profile of the geographies that they're operating in. If you're talking about places like Nigeria and the oil producing countries, you probably want to have a cost of equity of approaching 20%, and we don't think that's necessarily baked into the current valuations now.
To close off with, there is still a bit of noise in the market. We do see the fraud activity that took place with Standard Bank recently through an ATM scam. Barclays, you've mentioned the spinning off of, or rather divestment of their London partner. And I think Nedbank with Old Mutual trying to ensure that they have very separate independent units. Should investors be paying attention to such noise on the market?
So I think that big corporates can sometimes get these things wrong in terms of the cycle, and obviously for large investors, let's take Barclays Group PLC, for them to be taking a view, and they haven't said this publicly. I mean, our view would be that they're going to be exiting the Barclays Group Africa over a period of time. I don't think they can say wholesale that they're going to sell it today, because that's not clever in terms of managing the share price. But my view would be that they've taken a call to exit that asset. And that's got to be a view that they're taking on the continent, as well as the impact that owning a non-controlling stake in Barclays has on their capital rules in Europe, where they're going to effectively take all of the pain for those risk-weighted assets in terms of their capital provisioning, but not have the ability to control that asset. It doesn't make a lot of sense for them. So our view would be that a lot of it is capital driven in terms of their own decisions internally, and ultimately, if they were very bullish on the long-term view for Africa, you would be taking the view that they would want to hold on to it. But it doesn't make sense for them to hold a non-controlling stake necessarily. You want to have control.
Precisely. Well, we'll leave it there for today. Thank you so much for your view on the South African banking sector. Clearly, both First Rand and Barclays Africa coming out as keen favourites in the South African banking environment. But a big thank you once more to Sean Ashton and Liam Hechter, both from Anchor Capital. Join us again next time, where we talk more stocks.